Okay, you're watching the crypto charts, right? You drew your zones, you waited patiently, you saw the breakout, you jumped in, and then bam, just like that, the market tanks, turns right against you. Sound familiar?
Oh yeah, absolutely, that feeling.
You might feel like the market's just cruel or totally random, but what if? What if it was actually a trap and you just walked straight into it?
That's the uncomfortable question, isn't it?
Exactly. So today we're doing a deep dive into this really fascinating world of smart money versus, well, retail traders in crypto. We're going to unpack how these large market players really operate, why maybe retail traders often miss the crucial signals, and most importantly, how you can start seeing the market maybe less like chaos and more like, well, like choreography.
Yeah, like a dance. And we've pulled together some great insights for this. We're looking at stuff from decoding smart money, trading crypto like the pros, psychology of profit. We'll touch on the Wyckoff accumulation theory, which is classic stuff. Plus, risk management, macro things like the US dollar index, CPI data, and even found a pretty lively Reddit debate about whale manipulation. Always interesting to see those discussions.
Definitely.
So our mission really is to pull out the key nuggets, maybe spark some aha moments for you, and just help you understand those unseen forces kind of shaping the markets.
Okay, let's unpack this then. We're talking about shifting from just reacting to price swings to actually trying to understand the intent behind the moves, seeing the game differently.
Exactly, a whole different lens.
So first things first, who is this smart money exactly? It's not just like the huge hedge funds or the big whales, right?
Yeah.
Though they're part of it.
Right, they're definitely in the mix. But one source defines it quite elegantly, I think. It's any capital that moves with precision, patience, and purpose. These players, they don't just chase the pumps you see on Twitter. They often create them. They don't just react to patterns.
And is designed.
Sometimes, yeah. Or at least they exploit the predictable reactions to those patterns.
Okay, and what's really striking there is the contrast with, the average retail trader, who often gets driven by emotion, right?
Totally. Think about it. FOMO kicks in, chasing momentum, buying breakouts way too late.
Or panic selling at the bottom when everything looks terrible.
Exactly. Smart money, though, it's a much calmer, calculated game. They're planning weeks, maybe months ahead. And this is critical. They react to the reactions to headlines, not necessarily the headlines themselves. They've studied these emotional cycles for decades.
So how do we spot them? Are there like footprints they leave behind?
Yeah, you could call them footprints. There are some telltale signs you can look for, like sudden spikes in volume with no obvious news driving it, or these sneaky liquidity grabs near levels you thought were solid support or resistance.
The fakeouts, those are frustrating.
Very. And they're often designed specifically to trap traders. They aren't just random moves. They look for where people are vulnerable, where they're trapped emotionally or by standard technical analysis.
And that's where they make their move.
That's exactly where they act. It's about seeing that invisible game playing out.
So connecting this to the bigger picture, it's like the market isn't random noise. One source said, it's designed not by conspiracy, but by behavior patterns that repeat because emotions repeat.
That's a great quote. And smart money has basically mastered anticipating those emotional waves. It lets them position themselves way ahead of the curve.
Okay, let's make this concrete. There was an example in the sources, right? On a BTC USDP chart.
Yeah, a 4-hour chart example. Classic liquidity sweep, a low, $25,800.
Okay, so price dipped below that key support.
Right. And what do you think retail did?
Panic sell. Thinking, oh no, it's breaking down, the floor is falling out.
Precisely. Classic panic selling, thinking the market was crashing.
So if retail was panic selling, what was smart money doing? And how could someone, watching closely, actually spot that it wasn't a real breakdown?
Great question. Because that's exactly where smart money likely stepped in. What happened right after that dip? You saw a bullish engulfing candle. Big green candle basically swallowing the previous red one. A strong visual sign.
Okay, buying pressure, overwhelming selling.
Right. And crucially, you also had RSI divergence.
Ah, okay. Explain that quickly.
Sure. The RSI, Relative Strength Index, it's a momentum indicator. Divergence is when the RSI starts moving up, showing strengthening momentum, even while the price is still making a lower low.
So it's like a hidden signal. The selling pressure is actually fading.
Exactly. It's a classic sign of an impending reversal. And to top it off, there was a big volume spike right on that reversal candle.
Gotcha. Candle pattern, divergence, volume confirmation.
Textbook accumulation move, according to the source. Smart money essentially used fear to fill their bags, buying up what retail was panic selling. And if you're looking at multiple time frames zooming into the 1 hour, 15-minute, you might have even seen the setup, the trap being built before that big reversal candle.
Okay, so that's an individual trap.
Yeah.
But smart money also operates within bigger market cycles, right? This Wyckoff theory comes up a lot.
Yes, Wyckoff is fundamental for understanding institutional behavior. It breaks the market down into phases: accumulation, markup, distribution, and markdown. Today, we're really focusing on accumulation. That's the key phase where the big players quietly build their positions.
Right, and accumulation it's that quiet phase, usually after a big drop, where price just goes sideways.
Exactly. Often after a downtrend, characterized by that sideways chop, it's when smart money or institutional investors buy assets at lower prices, basically setting the stage for the next big move up. And it's not quick. This can drag on for weeks, even months. It requires real patience. They're building a foundation, not just scalping.
Okay, so if it's this quiet, drawn-out phase, how does it actually play out? Wyckoff breaks it down into steps, right? Like acts in a play. What's the first thing after the big drop?
Typically, it kicks off with a selling climax. Think sharp, emotional drop, massive panic, really high volume.
That's where retail finally throws in the towel.
Often, yeah, capitulation. Everyone's fearful, exhausted, just wants out.
Okay, so after that big flush out, what's next?
Then you usually get an automatic rally. Price bounces back up a bit. Buyers, often smart money, step in to grab those discounts. Causes a temporary rebound.
But just temporary, not the start of the real move yet.
Not necessarily. It's just a rally for now. Then comes the secondary test.
Testing what?
Price comes back down to retest the support levels formed during that automatic rally. It's checking if the selling pressure is really gone, if the market's ready to consolidate.
Okay, makes sense.
Yeah,
and then the spring. This sounds like the tricky part, the trap.
Absolutely pivotal. And yes, very often a trap for retail. The spring is a temporary dip below that established support. Sometimes it even breaks the low of the selling climax.
Ouch. So it looks like a confirmed breakdown.
Exactly. It's designed to trick any remaining sellers, trigger those stop losses just below support. You feel that I gotta get out now feeling.
Yeah, definitely.
That's the spring shaking out the weak hands right before the real move up often starts. It's a deliberate move to absorb any last bit of selling.
Okay. And after the spring, the last point of support.
That's basically the final confirmation. It signals accumulation might be ending, and the markup phase, the actual uptrend, is about to begin. The final retest before liftoff, hopefully.
Got it. Now, there's another concept tied to this, absorption. What's that about? Sounds a bit hidden.
It is often hidden in plain sight. Absorption is when large players are basically taking the other side of aggressive market orders, but they do it without letting the price move much. Imagine loads of buyers hitting the buy button, really aggressive, but the price just stalls, doesn't go up. Looks like a failed attempt to most people.
Okay, why would price stall if there's heavy buying?
Because a big player or players are sitting there passively soaking up all those buy orders with their own large sell orders. They're letting the aggressive buyers bring liquidity to them.
So you see effort, like big buying volume, but no result, like price staying flat.
Exactly, or the opposite, big selling volume. But price isn't dropping much because someone's absorbing it all with buy orders. That's absorption.
That's significant because
It's often a critical early warning. It's foreshadowing. If you see huge buying being absorbed without price rising, it means powerful hands are quietly accumulating massive supply, preparing for when that supply dries up and price can surge. They're building positions without tipping their hand too, obviously.
okay, so they accumulate quietly, absorb selling, and then sometimes they actively go hunting for liquidity. That's the liquidity grab, where it feels like the market's deliberately out to get you.
Yeah, that's often the next step, the liquidity grab. Smart money pushes prices into known liquidity zones, places where stop losses tend to cluster specifically to trigger those orders and gather capital. It's not a glitch, it's a market mechanic.
And why do markets move? Not just breakouts.
Well, according to these sources, markets move fundamentally because someone needs liquidity to fill large orders. And where's the easiest place to find it?
Where everyone else has their stops, or where they'll jump in on a breakout.
Exactly. From the most predictable behavior in the world, retail traders chasing confirmation or panicking out of positions, smart money knows where those clusters are.
So how does a grab work? They push price down below support?
Right. Push it just enough to trigger all those stop-loss sell orders below a key level. Retail panics, sells more. Smart money then quietly buys into that fear, scooping up cheap coins.
Or the opposite above resistance?
Yeah. Push price just above resistance, trigger breakout buy orders, FOMO kicks in, Everyone jumps on board.
And smart money sells to them.
Yeah.
Distributes their accumulated holdings into that excitement.
Precisely. As one source bluntly put it, the breakout above resistance that's not a breakout, it's a honey trap.
Wow. Okay, this inevitably brings up that whole debate about whales manipulating the market. You see this constantly online, like on Reddit.
Oh yeah. That Reddit thread was interesting. Some traders there describe it very vividly, like one big game. They talk about whales maybe coordinating sells just to liquidate leveraged traders.
Forcing prices down to trigger liquidations.
Yeah, and then buying back cheaper. Some even speculate they might see exchange data showing where major liquidation levels are. Scary thought.
Not everyone agrees it's outright manipulation, right?
Yep.
The sources presented another side too.
Correct. Some argue there's no concrete proof of actual legal coordination. They suggest these large moves might just be big holders, whales acting independently, maybe taking profits or rebalancing. Their argument is it might be more about providing necessary liquidity to prevent wild price swings rather than deliberate fraud.
So manipulation versus just sophisticated strategic trading using large size. What stands out to you in that debate? Does the label even matter for the average trader caught in the crossfire?
That's a really good point. What stands out to me is, well, whether you call it manipulation or savvy market making or institutional flow, the effect on the unprepared retail trader is often the same. They end up on the wrong side. So maybe the label isn't the most important thing. It pushes us away from simple good guy, bad guy narratives and towards understanding the mechanics. How do large players operate within the rules, anticipating behavior, using their capital, and maybe info advantages? The name doesn't change what happens on the chart, you know?
Yeah, that makes sense. Focus on the how, not just the who or why. Okay, so moving beyond just watching price, one source had a strong take. Price alone is a lie. It shows you the result, not the struggle. We need to look deeper.
Exactly. Price is just the surface. How do we see the underlying struggle, the real battle? The volume profile is key here. It doesn't just show volume over time like this standard indicator at the bottom. It shows volume at specific price levels. It reveals where decisions were actually made, where significant agreement or disagreement happened. It shows the layers, the footprints, the memory of the market.
Okay, so what are we looking for in the volume profile?
Two main things. High volume nodes, HVNs, and low volume nodes, LVNs. HVNs are those fat parts of the profile. Areas where lots of trading happened, buyers and sellers found balance. Price often gets drawn to these levels and stalls there, like magnets. A study mentioned found over 70% of major reversals happen at these HVNs.
So areas of strong support or resistance based on past activity? What about the thin parts, the LVNs?
Those are low volume nodes. Think of them as air pockets. Areas where price moved through quickly in the past, very little trading occurred, indicating rejection of those price levels. Price can often fly through them with very little resistance on the way up or down. Over 80% of impulsive breakouts apparently happen through these LVNs. They show paths of least resistance.
Okay, so volume profile gives us a map of market memory. Now, to really get into this smart money game, there's a whole language, isn't there? Specific concepts to use, SMC, smart money concepts.
Yeah, absolutely. Understanding this terminology helps you spot those footprints we talked about. Let's touch on a few key ones.
Like order blocks, OB. What are those exactly?
Order blocks are basically visible zones on the chart, often a specific candle or range where institutions likely place significant buy or sell orders. It's where they accumulated or distributed without causing huge spikes. Often looks like a little consolidation or ranging market before a big move.
Okay, so potential launch pads or distribution zones. What about breaker blocks? That sounds more aggressive.
It is. A breaker block is essentially an order block that failed. Smart money lets price break through it, specifically sucking in traders who think the level's broken.
Like triggering stops or breakout trades.
Exactly. And then they reverse price hard in the opposite direction, leaving those traders trapped. They break the structure momentarily to break the traders betting on that structure, holding or failing conventionally. It's a deliberate trap using a failed OB.
Gotcha. Sneaky. What about fair value gaps, FVG? You see that term a lot.
FVGs, or sometimes called imbalances. They're gaps left on the chart during very quick, impulsive moves. Price moves so fast that it leaves an inefficiency, a gap between the wick of one candle and the wick of the candle 2 periods later. It signals a strong imbalance between buying and selling. Smart money often looks for price to return and fill these gaps later, seeking market efficiency. They act like magnets for price too.
Okay, and then there are terms about market structure shifts. Break of structure, BOS, and change of character, chart. How do they fit in?
Right. A break of structure, BOS, is pretty straightforward. Price makes a new higher high in an uptrend. or a lower low in a downtrend. It confirms the trend is likely continuing, like the market saying, yep, still going this way. But a change of character, that's different. It's usually the first sign a trend might be ending. It's when price breaks the previous lower high in a downtrend or the previous higher low in an uptrend. It's an abrupt shift, maybe changes in volatility or volume too, suggesting the underlying dynamic is changing. Maybe smart money is starting to position for a reversal.
So BOS confirmed the trend. Choch signals a potential reversal.
Generally, yeah. Choch is often the earlier, more subtle sign.
And underlying all of this is liquidity, right? That seems to be the fuel.
Absolutely. Liquidity is just pools of orders. Think about obvious places.
Below.
Below old lows, above old highs, along trend lines where people place stops. Double tops, double bottoms, classic liquidity zones. These are the areas smart money often targets because that's where they can get their large orders filled efficiently by triggering all those resting stops or breakout entries.
So if you understand these concepts, OBs, breakers, FEGs, BOS, Choch, liquidity, you start looking past simple patterns.
Exactly. SMC traders try to gauge the intentions of institutional players using these concepts. It's about understanding the why behind the moves, not just reacting to the what. It gives you a more structured way to read the market's narrative.
And a practical tip that came up, always use multiple time frames.
Crucial. Zoom out before you zoom in. Get the big picture story on the daily or weekly chart first, then drill down to the 4-hour or 1 hour for setups. Prevents you getting lost in the short-term noise.
Makes sense. Now, it's not just charts, is it? Big economic news plays a huge role, like the CPI report inflation data.
Oh yeah, huge impact. When CPI comes in hotter than expected, inflation fears spike. And what does retail typically do?
Dump risk assets, sell crypto.
Predictably, yes. Knee-jerk reaction. But here's where it gets really interesting. Connecting back to smart money. While retail was panic selling on that hot CPI print, what was smart money doing, according to one source? They waited.
Waited for what?
They watched the whole market react. They saw the US dollar index, DXY, spike initially, but then reverse. They saw bond yields hit resistance. And critically, they saw Bitcoin hold a key support level despite the scary news.
So they're looking at the intermarket reaction, not just the crypto chart reacting to the headline.
Exactly. They react to the reaction's sustainability in the broader context. A higher CPI generally does put pressure on crypto short-term as people flee risk. Though long-term, some still argue crypto is a hedge against that very inflation CPI measures. Different time frames, different narratives.
Right. And you mentioned the DXY, the US dollar index. That's another big macro factor, often an inverse relationship with crypto.
Typically, yeah. A rising DXY means the dollar is getting stronger. Investors often move towards perceived safety, the dollar pulling money out of riskier assets like crypto.
Strong dollar, bad for crypto usually. Weak dollar.
Weak dollar, falling DXY can boost crypto. Investors might look for alternatives, hedges against that dollar weakness, and crypto is one place they might turn.
But you mentioned narratives. Isn't there sometimes a story where crypto is seen as a hedge against dollar problems like high inflation? How does that fit if a strong dollar is usually bad? Seems contradictory.
It does seem contradictory on the surface. That's a great point. The key is usually the time frame and the reason for dollar strength. That inverse correlation, strong dollar bad, weak dollar good, holds most strongly for short-term trading flows. Money moving around based on immediate risk appetite. The crypto as a hedge narrative is more of a long-term investment thesis. If the dollar is strong because of underlying problems like runaway inflation or massive debt, then some investors, including smart money, might still allocate to crypto as a potential store of value, like digital gold, precisely because they fear the dollar's long-term stability.
Okay. So short-term trading reaction versus long-term hedging strategy. Got it. But there can be exceptions, right? Crazy market sentiment or big crypto-specific news could override it.
Oh, absolutely. Nothing is 100%. Extreme fear or greed or a major regulatory announcement can definitely decouple things temporarily. Always layers to consider.
And ultimately, whether it's a chart pattern trap or a macro reaction, what's being exploited? Human emotion, right?
Bingo. FOMO, fear of missing out. FUD, fear, uncertainty, and doubt. Those two drive so many poor decisions. Retail buys the top, driven by FOMO, then panic sells the bottom, driven by FUD.
Falling right into the hands of those waiting to buy the fear or sell the hype.
Smart money doesn't fight that emotion, they use it. They anticipate it, they plan for it, they profit from it.
Which leads to a really powerful question for self-reflection.
Yeah. If you feel excited to buy, ask yourself who's selling to you. If you feel panicked to sell, who's buying from you? forces you to pause and question if your emotion is the signal or the bait.
Heavy stuff. Okay, so if we want to move away from being the bait and trade more like smart money, it's not just about spotting patterns. It's about defense first, risk management.
Absolutely fundamental. One source put it perfectly. Risk isn't a setting. Risk is the system. It's not just a stop loss. It's the foundation of your entire trading approach.
So what does that mean practically?
It means job number one isn't be right. It's protect capital. So you can trade tomorrow. That involves, first, predefine position sizing. Decide how much you're willing to lose before you even think about gains. Usually a small, consistent percentage of your capital, like 1% or 2% per trade, removes the guesswork.
Okay, risk percentage first. What else?
Second, structured stop placement. Your stop loss needs to be based on market logic, like if price goes here, my trade idea is clearly wrong, not based on how much pain you can tolerate or some random round number. Logic, not emotion.
Right. And third, avoiding getting cocky.
Crucial. Avoiding overconfidence. The source had a brutal line. Every blown account was once a winning account. Oof.
Yeah.
Overconfidence makes you break your rules. Bigger size, ignoring stops, leads to disaster. It's a constant fight against your own ego.
So defense is key, but smart money also seems defined by waiting, patience.
Immense patience. But it's not passive waiting. Patience isn't inactivity, it's precision. It's being highly selective, waiting for your A+ setup where everything aligns.
Like a sniper.
Exactly like a sniper. The source used that analogy. He spends hours, sometimes days, watching a window still, quiet, invisible. Is he inactive? No. He's locked in reading wind, measuring distance, studying movement, waiting for that perfect shot. That waiting is an active position. And sometimes no trade is the best trade. Resisting the urge to just do something.
I think we can all relate to that urge. The sources pointed out some of the worst trades you'll ever take happen right after you say, I'm just going to take something.
Yep. Confusing activity with progress. Big mistake.
So risk management, patience. What's the final piece for developing this awareness?
This might be the most important for long-term growth. Keep a journal.
The trading journal.
Yes. Track your trades, yes. But also track your emotions when you entered and exited. Track the setup. Why did you take it? Why did it work or fail? Over time, patterns emerge not just in the market, but in your own behavior. You start seeing your biases, your triggers. That self-awareness is how you start aligning yourself with the market's real rhythm instead of your emotional roller coaster. It's how you learn the choreography.
Okay, incredible. So we've really dived deep today. We looked at how smart money operates accumulation, distribution, those cunning liquidity grabs.
Yeah, and how macro factors like CPI and the DXY play into their calculations, moving beyond just the charts. It's a game of psychology, patience, and precision.
Definitely not random chance.
And the goal here isn't just about spotting these things. It's about understanding the market's rhythm, how emotions drive predictable behavior, and how your behavior fits into that bigger picture. When you grasp that, you hopefully stop being the predictable liquidity.
And start trading with awareness, with intention.
Exactly. Seeing the invisible hand, or at least understanding how it tends to move.
So the final thought for everyone listening, what does this all mean for you? Next time you pull up a crypto chart, don't just see flickering candles and lines bouncing around. Ask yourself this: what kind of music are you dancing to in this market? And did you write the score yourself? Or are you just dancing to someone else's tune?